Welcome back to FinWeek Money Matters. With Twitter and the IPO in the spotlight this week, FinWeek thought that it would be interesting to ask the experts for their advice on investing in offshore tech companies and which ones are offering particular value at the moment. Joining me at the desk, FinWeek journalist Jessica Hubbard, Mike Tonkin, Head of Institutional Sales at Saxo Capital Markets, and Nick Norman-Smith, CIO of Lentis Asset Management. Thanks for joining us.
Thank you.
Mike, I'm going to start off with you. Let's quickly talk about Twitter because everyone's tweeting and talking about it. I mean, the stock went to $50, an intraday high of $50. It settled at $45.10, and you're looking at a company now valued at $24.5 billion. I mean, of course, it hasn't been a Facebook story, the debut that is, but do you think it could be?
You know, I think it was a good IPO, and I think that's what the market was worried about after what happened with Facebook. And we know it's taken Facebook a year to get back to the same price basically that it listed at. So I think everyone was looking for this to go as smoothly as possible. I think it was handled really well. But I think there's some. If you dig a little bit deeper, you'll see that there's a lot of reasons why it went off as well as it did. And if you dig even further than that, and the guys around the table here might be able to give us a little bit more information on valuations and things like that. But there's nothing to say that the stock couldn't come off significantly from these levels.
I just have a quick question on that. Why did they decide to list on the New York Stock Exchange as opposed to NASDAQ?
I'm actually not entirely sure. I just don't think the NASDAQ handled it very well at all. I know the New York Stock Exchange did extensive back testing on a lot of volume going through in the weeks leading up to this, so they were very, very well prepared. The marketing around it was done very, very well. But that decision, I'm not entirely sure.
I mean, Oracle actually has recently moved their listing from the NASDAQ to the New York Stock Exchange. So whilst NASDAQ is typically tech focused, obviously the New York Stock Exchange has done some marketing, maybe provided some incentives.
Interesting.
So when we talk about the world of tech companies to invest in, and of course in South Africa we have a few, but not quite, certainly not on the scale of the international giants. I mean, what groups do you classify them in? Because we've got the Twitters and the Facebooks, but of course there are many different areas of the tech space we could look at.
Yeah, I mean, I think maybe from grouping it in terms of a valuation perspective, at Lentis obviously we like highly attractive businesses with big barriers to entry. Now in the tech space, that's often quite hard to find. I mean, websites, we've seen MySpace is getting taken over by Facebook. There's a lot of, it's very easy for new entrants to come in. But you can get a handful of really high quality businesses that have big barriers to entry. So Google's got a massive barrier to entry. For someone to invent a new search engine and move everyone across, very difficult. Microsoft.
Sorry, aren't we seeing that oftentimes the hype doesn't actually match the real value? So there's sort of the boring ones where you can make real returns, and then there's the social media guys and the Groupons of the world who don't actually create that much value. Am I right in saying
absolutely.
that?
And also, as we see in investing, the problem is that people look at the future and they think this is all exciting. So let's take it back 13 years to the dot-com bubble. People looked ahead and they said, wow, everyone's going to make a lot of money out of the internet. And they were right. Intel's going to sell chips, Microsoft's going to sell software, Cisco's going to sell routers. And everyone was completely correct. But people paid 65 times earnings for Microsoft. By the way, people paid 50 times expected revenue for Twitter to show you just how it was at a different stage of the business, fair enough. But the point is, people were 100% correct with their predictions. But these businesses were way overvalued, and as an investor in these businesses, you did incredibly poorly and are probably still down. Now, people are so tired of this that you can actually buy those great, boring old businesses who've got their problems of their own with net cash on their balance sheet at 10, 11 times earnings. So that's the real opportunity. As usually in investing, it's not the exciting stuff, it's the boring stuff.
Yeah. Could I perhaps bring this conversation down a notch to individual investors who know nothing like me? So I watched this video today where this guy said Twitter doesn't really make anything. Twitter's not a profitable business. And here you've got everyone throwing their money at Twitter. So if I'm looking at investing in technology companies abroad, what fundamental factors do I have to look at before I invest my money there?
Well, I think you need to break it down. You need to look at where is the money, and the money in this whole discussion is in advertising. But how do we get to the man on the street? How do those guys who are paying for the advertising get to you and I? And the reality is it's all mobile. And that's what the big driver for Twitter is. They have 250 odd million active users, and the majority, 70 to 75% of that is all on mobile. So if you acknowledge that advertising is where the money is, and you know that you need to get to people, and people are spending the majority of their time, whether it's banking, shopping, etc., on their mobile, this makes sense. This is the company that has access to those end users.
Are they going to monetize those 250 million people, and how? Because I think I'll be quite agitated when I start seeing advertising all over my Twitter stream.
And that's exactly it. And it's the same as Facebook. You know what it's like. As soon as there's something that comes on board where you're required to pay for it, or it starts getting too pushy on advertising, you leave or you walk away. And that is the problem. You just mentioned MySpace. Exactly the same thing happened. It was the darling of the online space, very popular, and it went bad very quickly. It just lost favor with the users very quickly, overnight.
Looking at advertising, so to go back to your question, what do I want in a business? I want a business that's unique and is able to repel competitors. Okay, now I'm sorry, selling advertising to people, really, that's not exactly a genius idea, and that was how everyone was going to make money in early 2000s, and look at how that paid out. No one made money off those businesses, really. People.
That's true, and it also doesn't take into account the Microsofts and things like that. Yes, it's true for social media companies, but what about other tech companies, the ones that you like, the more conservative ones? What are you looking for?
A business that has, I keep talking about barriers to entry, but the world is a competitive environment. If you go and open a lemonade stand around the corner and you've got great lemonade, it's not very difficult for someone else to come in and open next to you. So eventually your profitability gets eroded down to the marginal cost, and you don't make money more unless you can keep people out. So if you can find those businesses. So why Google was different is it's got a brilliant search engine and it's got everyone locked in, and they had a clever way of advertising which is different, and they opened the advertising market up to everyone else. So let's look at a few companies for examples. Oracle. So Oracle provides the underlying database software for companies. It's generally not that big a proportion of the spending of their company, but it's highly, highly, highly important. A bank cannot have errors with their client data. Same with various other businesses, pharmaceutical companies, etc. So Oracle have a great product. People are very nervous. We know what it's like in IT. You don't want to shift your IT at all, because that's when problems come in. So these guys can carry on charging significantly large amounts of money for a service, even though there's free ones out there. Microsoft Office. There have been free Office products out there for the last 10, 15 years, yet people stay with Office. Why? Because they've got a network effect. Everyone else has Office. It's interchangeable. It works. So you need companies with that, and they can sustain that cash flow. That's better than the exciting story.
So Mike, for South African investors, what is a good way? How are some good ways to get exposure to these companies that we're talking about? Are there any specialized technology funds that people can look at?
Well, it's interesting that you mentioned that, because I think up until recently, the main access point for a lot of retail investors in South Africa was to go and find a unit trust or a fund that were specialized in tech, or had a large tech holding, or had that particular company. But that's all changed. I mean, South African investors can very easily now open an account with an offshore broker, very easily take funds out of the country as well. Exchange controls have completely been relaxed.
It's still expensive though.
Well,
the
costs have come down significantly, and that's made this far more accessible. I mean, it used to be very, very expensive to trade offshore. The costs have been pushed down.
I'd almost say it's cheaper than trading locally. There's a lot less taxes and stuff in the US, for example.
Oh, really?
And the volumes are there, and it's the technology is available now. You don't need to be on the phone to your broker in London anymore. Everything's gone online.
So it makes more sense to go to a broker, open an account, say these are some of the tech stocks I've got my eye on, this is my investment horizon and all of that, as opposed to trying to find the unit trust in South Africa that gives you that exposure.
I think it's the same as with any investment. It depends how much control you want over it. But if you're comfortable enough to be buying locally listed individual stocks in a JSE portfolio, there's nothing to stop you from doing the same thing overseas. But like with anything, maybe you do want a unit trust, or you want an asset manager to make those purchase decisions for you, then that's absolutely fine. But there's no barriers anymore to where you can buy and invest your money.
I want to get into some of these companies that you like, and we'll start off with you, Nick, and then we'll come to you, Mike, and talk about some of the tech companies that really offering value right now, because that's the key when you talk about investing. So talk to us, say, about Microsoft and how you see it positioned, where it's trading right now, and how you see it competitively placed in a world where Apple, of course, is the flavor of the month, the year.
Look, it's not as cheap as it was. We've chatted about it quite a lot. I mean, it's rallied from $25 to $37 in a relatively short space of time. So it's not as dirt cheap anymore. But people think of Microsoft as Windows Windows is dying because the PC is dying. Actually, 3/4 of Microsoft's money comes from Office and from enterprise software, which they still do much better than Apple, and I don't think anyone can argue with that. So those are entrenched businesses that aren't going anywhere. And by the way, they have Xbox and they have Windows 8, which they've launched, and we'll see how those go, and who knows, but you're not paying for that. So if Windows 8 isn't as terrible as people thought, and actually people still keep their PCs, then you're going to do quite nicely. If not, you're still getting a great enterprise business. And it's a good argument to be said that Microsoft's actually much more of an enterprise business-to-business business than it is a consumer business, although they're clearly trying to get into the consumer space at the moment.
But will Apple not eventually erode their market share?
Well, I don't see how they're going to, from an Office perspective. I mean, they're trying and they're giving away their Office products, but quite frankly, it hasn't been that expensive before. And actually, it's not free because you pay twice the price for an Apple PC that you do for a Microsoft PC. So you're paying for it in some way or another. So I think it's going to be very difficult for them to erode that. I don't think that Microsoft are going to do so well in their Surface tablets and all of that stuff. I think it's a very competitive environment. But once again, that's not really where the value is. So I don't see them doing it, but the future is uncertain. But again, at 10, 11 times earnings with billions of dollars net cash in their balance sheet, the odds are in your favor. You know, in 2000, when you were paying 65 times earnings, the odds weren't in your favor.
And you might? Where do you see value right now?
You know, I think that's very much the fundamental sort of argument, and those are the stocks. I mean, but let's face it, Microsoft, Oracle, they're not particularly exciting, sexy stocks, and they're the stocks you want in your portfolio perhaps, and that's where the asset managers come in. But if I can look at it more from sort of an emotional perspective, and let's be honest, Twitter, Facebook, retail investors, the majority of retail investors in South Africa who've been wanting to get into those stocks have been wanting to get into them for completely different reasons. It's because they know Twitter, they use Facebook, and they just are familiar with the brand. It's young, it's sexy, it's vibrant, and they want to own it. They don't want to own it through a fund, an ETF or a mutual fund, whatever it is. They actually want to own the shares themselves and be able to, over a dinner party, go, I actually own Facebook, and have you seen what it's done today? From a valuation perspective, I'm not even quite sure they're that into it or that interested in it. I just think that it's something that could potentially grow. And after what we saw yesterday, 75% jump in a day, you know, that's the sort of thing that gets retail investors rushing in. Because yes, where do they make their money? How do you extract advertising revenue? But it could also be the next best or the next big thing. And retail investors want a part of that.
Nick, you've got to jump in here as a value investor.
And that's an interesting point, because I think one could argue that when did retail investors really get so involved in stocks? It was probably the early 2000s, and look how that worked out for them. So you've got to be very careful.
What about locally? I mean, do we have anyone that's worth looking at? Some people call Naspers, even though it's a media company, they say it could be a technology bet in itself, because it owns part of Tencent and Mail.ru, even owns a bit of Facebook. So it's an interesting option as well.
And I think that probably falls into what Mark was talking about. That's the exciting, sexy, Tencent's on 41 times earnings. And it's in China, and quite frankly, the authorities could decide to shut something down tomorrow. Who knows? So there's a lot of risk there. And the valuation that you're paying, there's even more risk. But, I've been saying that when Naspers was at 500, now it's at 1,000. So who knows? But, from a value investing point of view, it's about avoiding those big drop-offs, and it's about compounding your capital. And putting your money into the dull, attractively priced stocks actually increases the odds for you a lot more than, and it's going to be boring around the bra. I would much rather talk about Twitter.
That's maybe where Apple's actually done quite well, because they've almost sort of sat in the middle. Good solid company, good valuations, etc. perhaps, but also they've got that sexy, familiar tech product, that we all know, and they've sort of married that quite nicely, and we've seen how well they've done.
But I mean, just coming back to this point, do you go for the hype? Do you go for what retail investors are looking at, or do you go for fundamental kind of valuation principles right now? I mean,
you always go for fundamental valuation.
Exactly, but could you ride this wave for a few years if you're looking at it, it from a shorter term trading perspective? Yeah,
perhaps, but a lot of people have got burned, because the problem is when people try and get out the door, they all rush very quickly. So we saw people who are buying Amplats at over 1,000 Rand when it was the darling of the markets, and Nortel and all of these other tech stocks. If you're really good, but no one has really, maybe George Soros, come up with a way of trading this momentum. Let's look who's made all the money over the years. Is it Joe Blogg's the momentum trader, or is it so-and-so the value investor? And generally value has trumped.
What are your thoughts on local technology companies? Because a lot of people have accused them of just simply being resellers of other people's ideas and not really innovators in themselves. I mean, what do you think there's anyone really worth looking at the moment? Data Tech, for example, has always been...
Yeah, I mean, I'm not familiar with the local companies and wouldn't want to advise on anything locally. I think there's a better place to do that. But to answer your first question, there's such a variety of very competitive, cutting-edge technology companies locally. And it's kind of the message that we've been putting out, is to say that we need to start looking internationally. It's commonly known that we're less than 1% of the available investment opportunities out there, and I just think there's so much more out there. But individual commentary on local stocks, I mean, that's
Yeah, I mean, we're a little bit concerned. I mean, firstly, from a valuation perspective, there's not a lot of them that are particularly cheap. And again, where are the barriers to entry and where are those competitive advantages? A lot of them are resellers, and yes, they sell great products, but do you want to be the one who resells the Microsoft product, or do you want to own the product? And you always want to own it. So, there's times and places when these stocks look really cheap, but from a qualitative point of view, which you want to look at first, there's nothing that really excites us. Some companies have done brilliantly, EOH and Pinnacle. I mean, they've had fantastic runs, but I think there's much better value. And ironically, the companies offshore generally are cheaper and better quality. So, I mean, if you've got both of those, it's a bit of a no-brainer.
Let's get back to the old technology stalwarts and talk to us about Intel, because we're talking about Microsoft versus Apple, but Intel's also got competition from ARM, which is also a chip maker. They supply the likes of smartphone makers, essentially. I mean, does this pose a threat to them, coming back to the whole question around how this is valued right now relative to the new guys?
Yeah, always. And generally, these great companies are only available cheaply because there's something in the short term that's wrong with them. Otherwise, you'd never be able to buy them on those multiples, and it's going to feel uncomfortable. So Intel has missed the boat a bit in terms of the mobile space. As you say, ARM and Qualcomm and other companies have come in. But the reality is, this has happened to Intel before. Years ago, in PC chips, they fell behind. But Intel spends around the same amount of money per annum as the entire market cap of ARM. So they throw enough money at the problem, to be blunt, that they are going to come back. And they've started releasing new products and new chips. So they're an innovation machine, and they've got the scale to come back, and they generate phenomenal margins. So they're in a bit of a lull, and they're building up the capacity, but there's no reason why Intel should suddenly be dead. And this company is historically traded on a significant premium. You can now buy it at a discount to the market.